Hello students and welcome to the lecture. So students, as we know that we are covering the financial knowledge and the banking awareness part of it. And basically we are covering the banking history section of this topic. Okay. We had started with the liberalization era. We had completed several facts and figures of the liberalization era in the previous lecture. And basically in this lecture, we are going to continue with the same topic. Okay. We will look upon some different facts and figures regarding the liberalization era. And also we will try to understand them completely. Okay. I hope that you revised the previous lecture before you have come for this lecture, as I expect you to be updated with the previous things so that you can grasp the facts and figures right now. Okay. So with this note, let's start this lecture. So the financial knowledge is the main topic. Banking awareness is a part of it. And the liberalization era of banking awareness is the next part of it. Okay. So basically right now we are going to discuss about the consolidation and the mergers of banks. Okay. So the public sector banks were consolidated to create a larger and more robust entities. Private and foreign banks expanded their presence through mergers and acquisitions and enhancing their market share and capabilities. Okay. So basically, this is just a paragraph. I read it for you. You could also do it for yourself. But what I'm trying to explain you is more important. We have seen that there are two main words, consolidated and merger. We have to understand these words. Because whenever we try to find out the meaning of these words and whenever we study about these words in the part of economics, accounts and finance and bankings, whatever you can say. Okay. So mostly time people assume that they are same thing. Okay. And at that point they are wrong because these are not the same thing. All right. Even in the topics heading, you can see it. If the consolidation and the merger are the same part, so it will be like this one, consolidation or merger, right? This should be the heading of the topic. But what is the heading of the topic? Consolidation and merger. It means the consolidation is not a part of merger, neither merger is not a part of consolidation. Okay. So if they both are different, then why the people assume they are same? And what is the significance of these words in the banking sector? Okay. So let's understand them one by one. So the first is the merger. Okay. So it's basically a practice for acquiring or merging of two or more and business entities and form the single one. Okay. So it's basically a practice for acquiring or merging of two or more business entities and form the single one. It is called the merger. Okay. And remember one thing, only one entity comes out. Okay. So in merger, only one entity comes out, like X, Y and Z. These all three are the different entities. X is different, Y is different, Z is different. Okay. Then they decided to merge with each other and they got merged, but only X comes out. So the Y and Z got merged into X. Okay. This is an example of merger in which two or more business entities formed a single one and only one entity comes out. Okay. Like we had taken example. So what do you mean by the consolidation? It's a practice in which two or more, you can say. Two or more business entities combine together and form the new entity. Okay, so in consolidation, it are practices in which two or more business entities combine together and formed a new entity. It means the older ones were eliminated or were ceased to exist. Just take an example. X, Y, and Z. Okay, these three are the different entities. They all come together and combined their resources and formed a new identity named as ABC. This is an example of consolidation. They all combined their properties, combined their assets, okay, took over each other's liabilities and formed a new company and a new entity ABC. So that is the merger and consolidation. That's the difference. In merger, two or more, you can say the entities combined, but only single one formed. Like XYZ combined, but only X formed. In consolidation, more business entities combined together and formed a totally new one, like ABC. Okay, so because there is a combination, you can say combination of entities, that's the main reason people often get confused between the consolidation and mergers. But because there is formation of totally new entity, in the case of consolidation, and there is only case of one entity, that's create a difference between them. Okay, so the question is why it was important. So let's take example. Suppose X having 10, Y having 10, Z having 10. Okay, this is their capacity they all having. And right now the market demands 30 lakhs. Okay, if you look at them individually, none of these banks is able to meet the demand. Okay, it means that they are losing the opportunity which they have in front of them. Alright, so if they talk with each other, their management, their board of directors talk with each other, okay, and then they find it suitable if they got merged, then their resources like 10, 10, 10 will be combined and the 30 lakhs will be formed out. Alright, and that's how it's become a merger. Alright, and merger bank could only be in form of X, Y, and Z because as we had discussed, only one entity could comes out. Okay, so that's why they merged together and Y and Z ceased to operate in their own name because they got merged with X. Sorry, X and Y will cease to operate because they got merged with Z. Okay. Similarly, in the consolidation, suppose we have A, B, and C. Three banks we have. They having 20, they having 30, they having 40. Okay. Consolidation could done for various reasons, like the competition, like the customer base. Okay, so suppose if there is a competition, there is a other banks like there is a bank of P, there is a bank of Q, there is a bank of R, there is a bank of S, and they all having a huge capital investment with them, consumer base with them. They are dominating the banking market. Okay, and ABC are somewhat not so dominant in the market, but they wanted to be. Okay, so they could combine themselves and they formed a company CBA. Now the CBA will having the total wealth of 20, 40, 60 and this one. Total wealth is 90. And when they combine, their customer base will also combine, their resources will also combine, and then they formed a better competition to challenge these dominated banks in the market. That's why the consolidation and mergers necessary. Okay. And even as we have seen, some public sector banks were consolidated to create a larger and more robust entities. Because as we have seen, A, B, and C were individually not so capable to dominate in the market. Okay. But when they formed a CBA with a capital of 90 lakhs, they formed a robust entity to be defeated. Okay. Thereafter, also the private and foreign banks expanded their presence through mergers and acquisitions. Okay. Basically, if we talk about the acquisition, it is somewhat of different from the merger and the consolidation, you can say. It is to acquire the other entity in the market. Okay, this is the case of acquisition. Now you will ask me, what is the example of it? Just take an example. Suppose this is a bank called A. Okay, A having a good presence in the market. Alright, but now A wants to expand itself. Suppose it's only having 30 branches all over the country, but they want it to be 300 branches and more. Okay, so just tell me one thing. If they will expand their branches, so there will be cost, like the cost of construction. Okay, they will have to appoint a new staff. Okay, they also need to do the administration work. Alright, thereafter various other, you can say, miscellaneous expenses which to be bear by A when it's expanded its branch from 30 to 300 branches. Right? Okay. And this is costly. But suppose there is another bank B which having sufficient number of branches throughout the country. Okay. But due to various reasons like lack of management, mismanagement of funds, okay, and other so many factors which could be considered, B is a easy target to be acquire or purchase. To be acquire or purchase. Okay. So suppose if by expanding the branches by itself, A has to spend rupees 100 crores. Okay, just take an example. But if A acquires B, then it has to spend only 75 crores. So just place yourself in the case of A. What do you think? What is beneficial for you? Spending 100 crores, taking a risk, whether your branches will attract our customers or not, or just acquired the B in the rupees 75 crores, which is beneficial for you, and then you will get a automatic customer base because B already having the businesses in the country, you can say. Okay, so obviously if you are a rational and you are a sound management, then you will go for this one, not this one. This is the case of acquisition. Why the acquisition acquired? And over the time period since the 1991 to today's, private and foreign banks who having a good presence in the market, having the sufficient funds with them, okay, and whenever they want to expand themselves, instead of investing their money by the self expansion, okay, except some cases, normally they acquired a smaller banks and small entities with a good presence and all the things they wanted from it. This is called the acquisition. And remember, whenever the acquisition happens, there are two new entities formed. And these entities known as the parent company Okay. And the next company is the subsidiary company. Okay. So these two type of companies formed. Now let's talk about them. The parent company or holding company is basically the company which owns another entity by purchasing the company or acquiring the company. This kind of company is known as the parent company. Now let's have a talk about the subsidiary company. A company which has been acquired by the other company is known as a subsidiary company. Like if we go back to the example which we have taken, so A should be the parent or holding company because A acquired the another company. Okay. And B should be the subsidiary company because the B is the company which has been sold to the another party. Okay. So remember these points. All right. Now let's come to the next point. This point is known as the regulatory framework. To ensure the stability and integrity of the banking system, regulatory framework was strengthened. Reserve Bank of India was given enhanced authority and responsibilities as the primary regulator of banks. Okay. So when the 1991 introduced the NEP, or you can say the new economic policy, in which there were so many privileges granted to the banks. Like the foreign banks could enter in the market, private banks could enter in the market, even the public sector banks invites the application of private players to investment and all the things. Okay, that time it is necessary to look after the misuse or improper use of provisions provided. Why? Because now the foreign banks who are operating, the private banks who are operating could misuse the provisions and could harm the economy. Okay, and for the economy we had introduced these kind of policies. So that's why it was become very necessary to ensure to put a check on the banking activities. And obviously we had selected the Reserve Bank of India for this thing because when it was established in the 1934, basically it's act as a apex body, and when in the 1949 we nationalize it as a apex institution to supervise and control banking sector. Okay, that's why the regulatory framework is formulated by the Reserve Bank of India on time to time with the responsibilities to regulate a bank and also enhance their efficiency. Okay, so remember this point. Thereafter, the risk management. Bank invested in improved risk management practices, including credit risk assessment, market risk management, complies with Basel norms for capital adequacy, ensure the stability of the financial system. So basically, if we talk about the risk management, then is there any risk available to the banks? Yes. And the one kind of risk we had discussed already, which is known as the non-performing asset, right? It was a risk. If you remember the example, I had told you the bank had granted rupees 10 lakh as a loan and the accounts holders converted this as a NPA, non-performing asset. Neither the interest nor the principal amount returned to the bank. So this is the risk because totally the 2 lakhs has been losted by the bank. Okay. And this could even collapse the bank because banks required the capital to be operated and the capital belongs to the deposits and that deposit is used to grant the loans, right? So suppose if 10 lakhs provided to the bank ABC and they granted the 10 lakhs as a loan and these 10 lakhs become a NPA, then what will happen? Bank will run out of the capital and eventually collapsed. That's why risk management is very, very necessary because the banking sector is an essential part of economy as they promotes the investments, they promotes the loan activity so that people could do something productive. So if the bank's collapsing, then it means the economy will suffer in the upcoming time. Okay. So if we talk about the practices, including the credit risk assessment, what is that? Suppose this is the bank called ABC. This is the person who required rupees 10 lakh as a loan from the bank. Okay. And if that fellow and that person reach the bank and ask for the loan, what do you think? The bank will grant the loan immediately or easily? No. There is a documentation. There is a verification. There is a collateral security or collateral mortgage, you can say. Right? The bank will first ask the various documentation to prove him as a legitimate person, like Aadhaar card, PAN card, other documents will be required. Thereafter, his background will be verified. He should not be the defaulter. Suppose before reaching the ABC, he had already breached the terms with XYZ. Okay, he took a loan for 5 lakhs and didn't return it. So once he already defaulted and didn't pay the loan, and if it's found out in the verification process, the ABC will deny to give him the loan. They will say, sir, you have already breached the loan process. We are not willingly to give you the loan. Okay. Thereafter, the third step is, even if he successfully passed the documentation and the verification, the third step is collateral security, which means that if you are going to asking for the 10 lakh rupees loan, okay, you have to submit something of equivalent value of the loan amount with bank, and that is known as the collateral security. And what is basically the purpose of this security? Basically, because the security is of equivalent value, then this could be sold out by bank to recover loan amount. Okay, so suppose if the person who had taken the loan from the bank and somehow he is not able to repay the amount to the bank. In this case, because I have told you, mostly the deposited amount used to grant the loan, right? So if that person who had taken the loan of 10 lakh rupees is not able to repay the loan, but the bank will have to repay the loan to the debtors, to the person, depositor, sorry, to the person who had deposited their amount. Okay. So in this case, it is very, very necessary for the banks to somehow or anyhow, you can say, recover the loan amount. Then only the bank will be able to give the amount back to the depositors. and this could be done by the collateral security. So this is the credit risk assessment. Like, before granting the loan to any person for any amount, in this case we had taken the amount of rupees 10 lakh, the bank will verify whether the documents are original, the person is not the fake person. Thereafter, his background will verify. Has this person ever breached any bank, you can say loan process and anything? Thereafter, the collateral security of equivalent amount will be asked from that person. Only after fulfilling these conditions, the bank will allow to take a loan. So this is the risk assessment. Thereafter, the market risk management. What is meaning of this? Remember one thing. When I told you 1991 brought out the liberalization, then banks also started making the investments. Right? That's what I had told you. They were making the investments. So the investments which were making by the banks are basically making the market, or you can say financial market. Okay, either in the corporations, and you can say either in the securities and stocks. All right. So all kind of investments making by the banks are basically making into the market, and this is called the market risk management. Why? Suppose this is a bank called XYZ Bank. Okay. This is a company or corporation called ABC. Okay. So the bank had made an investment for rupees 1,000 crores with ABC. Okay. But due to some conditions, the ABC insolvent, or you can say shut down or wind up. If any of this case happen, 100 crores which had been invested by the banks are totally lost. Right? And because, as I have told you, investments, loans and other facilities provided by the banks are basically provided by the deposited amount. Okay, so it means that the 1,000 crores used by the XYZ is basically comes from the depositor's account, and the liability stands out to the depositors whom the money belongs to. So somehow the XYZ is required to borrow the amount from other financial institutions because they had lost their amount, and then they have to pay to the depositors. Okay, so this kind of risk assessment and management is known as the market risk management. It means that the bank should first analyze the market condition, analyze all the opportunities and threats, then they should make the investment into various corporations and the securities. Okay. Thereafter, complies with the Basel norms for capital adequacy. It means that, listen, the banks too required a money to operate. Okay, and that money basically comes out from three types. First is initial capital, and you can say capital of bank. Second is from the money deposited, and third is from the earnings of bank. Okay, capital of bank is basically the amount invested in the banks before of its starting, and also this belong to the owners of the bank. This belong to the owners of the bank or shareholders of the bank. Thereafter, the money deposited means the amount which has been deposited in the bank by the people, and then the earning of the bank. Okay, so these are formulates a part of the banking capital and money to operate to the bank. Okay, for example, 50 lakhs were basically the initial capital, 100 or you can say 1 crores has been deposited by the people and the bank earn rupees 20 lakhs from the market. So if we combine them, then we will find total rupees 1 crore and 70 lakhs available with the banks to operate smoothly, right? This is basically the capital adequacy. So how the bank could follow the Basel norms to follow this adequacy is basically the part of risk management. Okay. This ensured the stability of financial systems because this keeps the bank healthy and bank activities healthy. Okay. So remember these points. So students, basically in this lecture, we had discussed the several facts and figures like the consolidation and mergers, regulatory framework, and the risk management of the banks under the liberalization era and after the liberalization era. Okay. So I want you all to revise all these facts and figures thoroughly before you have come for the next lecture. With this note, let's end this lecture and thank you.